Alright, ladies and gentlemen, welcome to MACROACE with your host Tony. Thank you very much for joining me live. Ukomako says, let's do it! I am trying a new microphone just to kind of see how it is. Somebody did say that they couldn't hear me or was mumbling, but what I do a lot of is I kind of move my head around because there's so many things to look at. So it might be that, so hopefully this should sort that issue out for you, but hopefully you can hear me nice and clearly. Let's get into it. Nonfarm Payrolls, we've got less than 29 minutes left to the release. So first of all, we'll discuss what the release is about, okay, how it affects the markets, and then the sentiment surrounding the markets at the moment, and what to expect, and what the Fed are talking about, maybe some of the government members, and we'll look at the deviations for the economic release as well. Hey, Dragan says, hi Tony. Hello to you too. But yes, we'll look at what the deviations are for the economic release as well, and how the markets have reacted to non-farm payrolls in the past, and what to kind of expect, and what investment banks are looking at for their forecasts as well for the non-farm payrolls release. So first of all, it's the net amount of jobs created in the prior month, and there are two ways. William Riker says, did you get a worse microphone? I know it sounds a bit... it does sound a bit different using a headset mic. Just trying to test it out. I think there have been people who've talked about maybe not being able to hear me clearly, or if that's just mic gain is a tad too high. Let me kind of see if I can sort this out for you. Let's see if we can do something for you. Guys. I don't want it to be too bad. I don't want it to be too quiet either. Okay. Is that all good? Ooh, that is not going to do well. Oh gosh, that got worse. I'll have to leave it where it is. I think what I'll try and do... Hold on, let me try and do something. I'm going to switch the mics. Somebody said this microphone... Zislit says this microphone is great. Let's go, give us NFP. Yeah, I know it's not my usual rich dulcet tones. Dulcet tones. Okay, so let's kind of power through it. But now you can kind of hear me speak. So there are two ways the or the non-farm payrolls release is measured. Okay, so you have the household survey that represents the unemployment rate. Okay, and then you have the establishment survey, which is where the non-farm figures or the non-farm payrolls figure comes from. Right, so the establishment survey is questioning different businesses around the US, or over 440,000 sites, okay, in the US, and asking, how many people they have on their payroll, if they added any new jobs, or if they, how many jobs they added. Okay, so the household survey just kind of go through that, asking the workers, whether they're full-time or part-time employed, whether they're doing any, whether they're in employment or not. Is that better? Hopefully that shouldn't be too loud. I'm so sorry about this. Just kind of try to... Okay. So, let's carry on then. So how does it affect the markets then with non-farm payrolls? So what non-farm payrolls does to the markets for the currency at the moment, what we understand and what we've seen in the past year or so, is that if you do get a higher than expected reading, then that bodes well for the currency. First of all, fundamentally, it shows that the economy is doing well and that jobs are being added to the market. Okay, and the US economy is healthy, and then businesses are able to add more jobs. The second reason why the currency would go up is the expectation, or the current sentiment is that the Federal Reserve would maybe hike by a bigger amount or continue hiking for longer than expected. So if markets are expecting the the central bank to do another 25 base point hike in March and then one more in May. If non-farm payrolls comes in much higher than expected, traders could be expecting the Fed to do maybe another hike in June, maybe, or continue hiking, maybe even past June, depending on how strong the figure is and how the Federal Reserve takes that figure, and how they view it, and then what they make of it. That's the currency, okay? Of course, if you do see a much worse than expected figure, then that would have the opposite effect, that the Fed could maybe not hike by that much, or maybe pause sooner rather than later, and then that will lead to the currency seeing a bit of a depreciation. Now, for the stock market, it's very easy to understand is that in a normal environment where there's no tightening or rate cuts going on and monetary policy is all the same and fine, stocks see an appreciation generally when the jobs market is strong or stronger. But in this tightening cycle, when the Federal Reserve has a keen eye or hawkish eye on the jobs market and inflation, then that's taken in the opposite way. It doesn't bode well for the stock market because they expect the Federal Reserve to raise rates maybe much more or continue to raise for much longer. So stocks don't like a much better than expected non-farm payrolls figure, and that's with a big deviation. Okay, usually when you see sometimes the data is more or less in line with expectation, or there's a little bit of a deviation, you might get the market actually rallying off of the data because it hasn't been a blown out figure that the market's become scared of. Now, for the bond market, bond prices, okay, and bond yields, you've got to remember with bond yields, okay, let's go from what everyone kind of talks about when we're looking at the markets, how the bond market is doing. When you have a very solid jobs report, you get the bond yields that start to move towards the upside. Reason number one is because the economy is doing well. So what the government does is to try and attract investors to buy into government debt, but they give them a high yield because they think, okay, if the job market is doing well, stocks are going to start to do well too, so we need to attract those investors to invest in our bonds. So the yield starts to go up and bond prices start to head lower. The second reason, again, just as I said with the currency and how that reacts, bond yields start to go higher in anticipation of maybe a higher rate or higher terminal rate from the Federal Reserve, this current state that we're in at the moment, where we're getting towards the end of the Fed's hiking cycle, or maybe that they're expecting a bigger rate hike, maybe further down the line. So that's also another reason why bond yields will go up off a positive non-farm payrolls figure. So that's how it affects the markets. If anyone does have any questions, do let me know, and I'll kind of cover it off. But don't forget to share the video and like it as well. Subscribe to the channel. Barring the sound quality, hopefully everything else is all good. So the indicators that are weighing on sentiment at the moment then, okay, where is the US economy? So inflation at 6.5% compared to 7.1%, so a decent decline in inflation. PC price index also saw a decent decline in inflation as well, 5% versus the prior of 5.5%. GDP was also better than expected. The forecast for fourth quarter GDP, the advanced data, was 2.6%. But it came out 2.9%, so the dollar had seen a nice rally off of that data. Okay, again, so better than expected productivity figures from the US spurred a dollar strengthening. Compared to Q3, of course, it is slightly worse than Q3. Q3 was at 3.2%, but not heading towards that. It may be heading towards a negative territory much sooner. Maybe what traders might be expecting if we yet to take on the if it takes about 12 months or about a year or so for interest rates to take effect in the market, in not only the market but also the economy fully. But that's something that we've got to be aware of, is that productivity is weakening, but it isn't as weak as what traders may have anticipated in the last release. The unemployment rate was at 3.5% versus the revised figure of 3.6%. ISM Manufacturing Employment Index, which we had this week, was worse than expected at 50.6 versus a prior 51.4. The JOLTS job openings data as well was also much better than expected at 11.012 million compared to the prior of 10.458 million. Event Jesus List says, what about the NFP corrections of previous figures? These also come out today. They can do. They usually come out around the beginning of the year with the non-farm payrolls figure. Depends how much that could sway the markets. The markets could just be focused on how big the deviation is on between the forecast figure and the actual figure, and that might move the market, and people might forget about the prior being revised. But if you think about looking at the prior vision, yeah, that could still have an effect on how the markets react. But it's more so from an economist's point of view as to maybe there's been a lack of data that hasn't been pulled together or is missing for non-farm payrolls that could then sway sentiment not only for economists, but also and the Federal Reserve, but also traders too. So JOLTS, as I said, was better than expected. Employment costs as well, looking at the inflationary side as well, employment costs were down at 1% compared to the prior 1.2%, which was lower than the forecast of 1.1% for the data that we had. ADP employment change was also worse than expected. So it came out at 106k versus a prior of 235k. I believe the forecast was around 160k, something around then. So what happened was the dollar had seen a decline, and that's measuring the private sector of the economy. It's not an official government report, but it is still useful for traders to look at because sometimes they see it as a precursor to what to expect for the non-farm payrolls report when it comes up at the end of the week. There hasn't been a clear correlation, is what you've got to take away. That if ADP is low, then non-farm payroll is also going to be low. But it gives a hint as to if data is showing a weaker jobs market in the private side, maybe non-farm payrolls could show that too, or vice versa. It could show a stronger market if ADP comes in higher than expected. But that's something just to be aware of. Traders do use it as a way to kind of gauge what to kind of expect for the non-farm payrolls figure. But it doesn't mean it's always correct. Now, the triggers for the economic release then. So if we're looking at deviations of what economists are looking at and what are the current median forecasts that we have for non-farm payrolls. So the high estimate is 320k, bearing in mind, so there will be 130k deviation on the high end. Bear in mind the median forecast for today is 189k. You have a low estimate of 130k, so that's looking at around a 60k deviation. Okay, that's just what economists are looking at overall as a high and lows. So I think if we're looking at non-farm payrolls for a decent market reaction, or the market reaction that strong market reaction that we would want to see, that we've seen in the past, we'd want to see at least 60k to see a decent reaction from the markets, at least, considering how deviations have been shown up last time round. So unemployment rate, economists see a high estimate of 3.7% with a low of 3.4%. Average hourly earnings as well, that's also very key too. Now, if the headline figure non-farm payrolls comes in line as expected, but then you have average hourly earnings, which is much lower than expected. Remember, that's another gauge of inflation, right? How much are people being paid? Or what is the average hourly earnings that those employees are getting paid, right? If there seems to be a reduction in the amount that people are getting paid, or percentage, right? Then that bodes well for the stock markets, or the dovish Fed members saying, yeah, inflation is definitely heading towards our 2% goal because people are not being paid as much as they used to in order to be able to spend on goods and services within the economy. So that's one thing that we've got to be aware of. It is expected to drop down by 0.3% to 4.3%. from 4.6% for the average hourly earnings year on year. So that's going to have a key influence, which is what it did last time when we were looking at the non-farm payrolls figure. That if that is much lower than expected, that could rock the boat in the market and could cause the stock market to rally, maybe. And then, or vice versa, if it is much higher than expected, that could muddy the water and make it a bit harder to trade, or it might increase the amount of confusion within the markets as to which direction do we go in within the markets. So the high estimate for that is 4.7%, with a low estimate of 4.1%. So they're looking for 0.4% deviation on the high end and a 0.2 deviation low end. Private payrolls, they see a high estimate of 260k with a low estimate of 135k. Now, the investment bank views. So what are their forecasts for non-farm payrolls today as well? So Societe Generale see non-farm payrolls coming in at 205k, so hotter than expected, or hotter than the 189k. Unemployment rate seen at 3.5%, so unchanged. Also, JP Morgan looking at a figure of 196k, with the unemployment rate ticking down 3.5%. Bank of America and Morgan Stanley. So Bank of America sees 225k, with the unemployment rate ticking down to 3.4%. And then Morgan Stanley seeing non-farm at 175k, with the unemployment rate staying at 3.6%. So again, just more or less a mix in expectations. So you have non-farm payrolls. You have Bank of America, which is giving quite a high figure there, or much higher figure compared to everyone else here, being more optimistic maybe about the jobs market, or understanding that it is still going to be quite robust, and expecting it to go from 223k to 223k to sub 200k that quickly might not happen. Remember, you've also got to deal with if it's showing data from the prior month, then that's also going to have an impact on maybe from Christmas fallout. There might still be people that are being hired for clean up post Christmas period with any sales that are going on as well. So that's also another thing to bear in mind. Okay, apologies. We have an AC unit being installed in our office, so we are. So, oh no, the fan is now. The Hoover is now off. So, carrying on into the previous report we had in December, for previous report that we had, notable job gains occurred in leisure and hospitality, healthcare, construction, and social assistance. Payroll employment rose by 4.5 million in 2022, an average monthly gain of 375k, less than an increase of 6.7 million in 2021, which had an average monthly gain of 562k. So there is a clear distinction between how during the pandemic phase we had the data for employment, which was quite high because of all the money that was kind of being pumped into the economy at that time, and the low interest rates as well, or near enough to zero, with the interest rates in the US. So businesses were able to borrow a lot of money to get their businesses back up and running in 2021. But now, of course, that's moderated to around 375k in 375k in 2022. So there is a very noticeable decline in the amount of jobs that are being added because of the quickness in the pace of and the strength in the amount of hiring people during the COVID period. So that's going to be obvious. That's obviously going to drop down further as the effects of high interest rates take effect in the US economy, and for consumers too. If they're spending less because they don't have that much money to spend on goods and services. And also the other key point too, for a very long time, the unemployment rate hasn't got out of the 3.5, 3.7 range for quite a while. So that's been quite sticky. Now the Fed have said in the past that if they're looking to get the unemployment rate, some of the members would look to see the unemployment rate get to around 4% or maybe 5% to kind of, again, help dampen down inflationary pressures, right? That's their key goal. But that might not be the case anymore. They need to get to around 4 or 5% of the unemployment rate. Maybe it can be where it is, and inflation is still coming down by, sorry, not by itself. It is still coming down with the work that the Federal Reserve has done. It just depends on how much, or do we go, do we go from disinflation to deflation? Could that be possible with the amount of rate hikes that have happened? Maybe, maybe not. But that's we've got to wait and see how the inflation data reacts or acts in the first half of this year, and whether or not we seem to kind of be hovering around maybe, let's say, 4% by August, maybe, or so see where it gets. Now, Fed and government views as well. So you have Fed's bargain saying wage pressures will persist through the first quarter, but labour markets appear to be easing. Logan said elevated services inflation is a sign of an overheated economy and a tight labour market. Again, that's quite key. The services side is very key for if we're looking at the CPI figure for inflation. And also the PPI side too, not just for consumers, but also for businesses. Fed's Bullard said the Fed should move as quickly as possible to reach 5% and then react to data. So Fed's Bullard, being one of the most hawkish members of the Federal Reserve, saying, forget the data, let's get to around 5%. Okay, let's kind of see what happens when we get to a high point with the rate, the terminal rate, if that is our terminal rate. And then let's see how the economy fares, and if it reacts in a bad way, maybe then we'll do something. But of course, that's the implication from my point of view taken from Bullard. But just to simplify it, get to 5% and then see what happens in the economy. Waller says services are heavily labour dependent, and if wages continue to fall, it makes our job easier. Again, referring to the services side of inflation. Then investment bank views as well. So of course there have been some bad earnings. Actually, we had some very bad earnings yesterday with Apple and Amazon. It wasn't great. But there's also we've had tech layoffs that have been occurring. More or less trimming expenses is what it's been, or preparing for potential deep recession, or a hard-hitting recession that could affect the big tech companies, but not also just the tech companies. You've also got the investment banks too that have been trimming the fat as well. So on the 26th of Jan, Neela Richardson from ADP, chief economist, said the disparity between firm layoffs and various data points could be attributed to severance payments, and layoffs may show up in 6 weeks. So these people are being laid off, right? They won't show that they've been laid off if they're still getting paid, or if they're still on the books. Until that happens, only then will we know how big of the gulf is between the amount of jobs that are being added and the amount of people being laid off, and also see what the JOLTS data does as well the next time around, right? If it takes up to 6 weeks for the data to take effect. Then, of course, I already kind of talked about earnings already, so if we're looking at the week ahead as well, so if we're looking on 30th Jan, you had BMO's Jeffrey and Lingen said that the week ahead will not solely be a Fed story, as Friday's employment situation will provide clarity on the health of the job market to begin the new year. So there's also that too. So if non-farm payrolls is strong or solid for January, will the momentum be sustained and kind of carry on into the rest of the year, and how quick will that be? So again, so if that's the case with if we do get a strong non-farm payrolls report, could that shift the Fed's view? Is basically what BMO is also, or BMO's Jeffrey and Lingen are also saying too, in favor of maybe continuing to raise rates for longer. There's also that possibility too that could occur with the Federal Reserve. We've got about 5 minutes. So this is the last release, okay? Bearing in mind we have the Canadian employment data at the same time, but this is about 10 seconds before the last release that we had back on January 6th. Okay, so we'll kind of see how the markets reacted. So you had the S&P, which flew, right? Now the main reason why it flew is because of how you had, first of all, you had average hourly earnings, okay, which was, well, first of all, non-farm payrolls, you didn't see too much of a deviation there. There's about 20k deviation, okay, with non-farm payrolls. We were looking for at least about a 60k deviation non-farm payrolls to see a strong market reaction. We didn't get that. Okay, then you had the average hourly earnings, which is kind of scrolling up. Okay, so the average hourly earnings was forecast to decline to 5%, but it was much lower than expected at 4.6%. And that added to the fuel for the S&P 500 to go and the dollar to see it decline. Again, inflationary pressures are quite key to keep an eye out for within a non-farm payroll report, because that could sway the market in one way or the other. So again, that was, if we're understanding why the markets move that way, that's the main thing. Deviation wasn't that big. Inflationary pressures for average hourly earnings were going down as well. So that's also those are the two key points just to understand. Okay, so if I bring out the deviations, okay, so there we go. So you also had Fed swaps as well. Swaps traders trim marginally, made the amount of Fed hikes priced as well off of the back of the data. Let's get out of this. Let's go to the deviations for the economic release. We don't have too much time. Let's see how the markets reacted. We've got about 3 minutes left. Okay, here we go. So that is non-farm payrolls there then. So this is how it reacted last time. So this represents the figure here, the initial movement going to the wick of the candle, and then the brackets represents the movement 10 minutes after the release has occurred, going to the end of the candle. It's all on a 1 minute chart, by the way. So you can see that the S&P liked it. It was up 209 ticks, and after about 10 minutes of trading, it was up by 100 ticks from the release. So the NQ, well, the Nasdaq had seen 744 ticks towards the upside and 348 ticks post the release, from the release. Now the currency pairwise, so what had seen the biggest move was the dollar yen. Okay, that's consistently seen the biggest move. Dollar CAD, of course, you had the employment data from Canada as well. That was also having an impact on how the dollar CAD was moving, but the dollar yen has been the staple so far for market reactions. And then you've got your cable, which is your next one to be aware of. So if we're gonna keep our eye on the dollar yen, that's been our staple to kind of look at for market reactions. We have 1 minute left. Uno minuto. Let's go. Yep, yeah, there's a lot going on. Apologies. Hope you can understand. Alright, let's get, we've got about 30 seconds left. I'm going to get my TICKSTRIKE up and running. Okay, so let's get US releases. There we go. Preset. All ready. So we've got the S&P, got the dollar yen, and we've got the 2-year bond prices that we're looking at here, or the 2-year bond futures that we're looking at. Let's see what the markets do. Right, less than 10 seconds. Let's see what this baby does. Okay, 517k, higher than the forecast, 188k. Average earnings year on year, 4.4%, higher than the forecast of 4.3%. Unemployment rate, 3.4%, lower than the forecast of 3.6%. Average work week hours 34.7, 34.7. Higher than the forecast of 34.3. Private payrolls at 443k, 443k, higher than the forecast of 190k. Manufacturing payrolls of 19k, 19k, higher than the forecast of 7k. US labor force participation 62.4%, 62.4%, higher than the forecast of 62.3%. If we're looking at average hourly earnings month to month, as expected at 3%, so smashed it right there with non-farm payrolls. Well done, USA. Well done. That was at 517k. Damn, son. It's like somebody just, wow, look at that. Okay, S&P down, dollar flying, bond prices going down as well. Let's see how big this movement was. That's a huge amount. Okay, it's 121 ticks down on the S&P. TICKSTRIKE is going crazy here in my ears. Okay. Damn! What a way to start the year! Damn, son! Alright. Let's look at the pips. So, 112 or 113 pips towards the upside on the dollar yen. Yeah. It's bad for the stock market, great for the dollar. And let's see what the Fed kind of, or what traders are kind of feeling with the Federal Reserve. Let's see what they think. Let's look at bond prices. Gold, of course, is going to go down. Let's have a little look. Damn, smashed it. Don't even think about a 60k deviation. Forget about that, is what happened. Bond prices, 2-year bond price going down, 52 ticks. So gold, grab that up too. Jesus. Okay. 197 ticks towards the downside. If I'm just looking at my deviations for the economic release, if I bring that up again, see what the highest amount was on the dollar yen. Okay, so this has been the biggest move on the dollar yen, initial reaction wise, for non-farm payrolls, right? 112.9 pips, 113 pips towards the upside. Okay, S&P 121, not the biggest move initially, but let's look at the NQ, see how that fared. I don't think they're gonna like it. Tech stocks and not gonna like that. Let's have a little look. Okay, yeah, not as big as a reaction as last time. Still a big move, 460 ticks. But in the past, we've had, well, the last release that we had was 744 ticks as a move on the NQ. So not a huge move on, not as big as a move, should I say, on the Nasdaq, but still a decent move. Let's look at the Dow. Bring that up as well. See where the Dow did. So the Dow's the largest move. The Dow's move last time around was 267 ticks towards the upside. Let's see how big this is here. Okay, 202. Yeah. So the dollar loved it. Let's look at cable because that was the second biggest reaction. Has seen the second biggest reaction in the markets. So this is why you're seeing a bit more strength in the currency or in the dollar, right? Not only did you have non-farm smash it, right, but you also had the average hourly earnings also come in higher than expected too, right? So the forecast was 4.3%, it came in at 4.4%. Okay, there's a bit of a moderation compared to the prior. Prior was 4.6%, but it wasn't as weak as traders were. It wasn't weak enough for traders to say, okay, inflationary pressures are abating. It's taking a bit more time within the job market to take effect. Now, that is non-farm payroll. So 84 pips towards the downside on cable. I want to look at the euro dollar too. Let's have a look here. Bear in mind, you don't have Canadian data too, so it's solely focusing on what the US is doing. Last time I only had Canadian data kind of overshadow the non-farm payrolls figure itself. Euro dollar 76.5 pips. So yeah, currencies. Okay, here we go. Traders of US short-term interest rate futures are seeing a higher chance of the Fed rate hikes both in March and May after strong jobs report. So the idea of a pause sooner rather than later, whew, out of the window, baby. That's what traders are feeling at the moment. Okay, Fed policy rate peak rises to 4.96% for June versus 4.91% as well. That's also a key point. Where do traders see the terminal rates? Do they see it at 5% or do they see it maybe at 4.75%? But this data kind of it just slapped the market, and the dollar has loved it. Okay, now remember you're watching with Dragon CC said WTF. What do you mean? what's going on? Hugo Mako's got the dollar signs in the face. Okay, let's see what people have said here. So Zilla says love it. Sludge says holy guacamole. Wow, damn. Zilla says yeah, twice as much as expected by the worst expectation. Price wage spiral in the pocket now. Federal need to hike by 5,000 points. That'd be crazy funny. You know, I had I was trying this new headset. The other mic that I have allows me to do FX sound effects, so that would have been the perfect time to. Anyway. To do some funny voices, but we ain't doing that here. Who says sonks? I think sonks is a better word than stonks. Maybe that's a new word, John. DWT51 saying unemployment rate lowest since 1969. Yeah, it's damn. That's pretty darn good for the market, huh? Right. So, FinancialJuice is where you got the data, where we have the data from. A live voice and text service, okay, that allows you to understand why the markets are moving and capitalize on potential opportunities, but also manage your risk as well, right? A live voice and text service is something that the big boys investment banks have access to. Retail traders don't really have that much access to it because it's something that they're maybe not familiar with, haven't heard of it, or maybe they're just starting out with their trading, or maybe they've been trading for years and maybe it's something that they haven't really come across during their trading path. But having a live voice and text service is very key to understanding why the markets are moving. Okay, if it works, just look in the charts, fine, by all means, do that. But to really optimize your trading, having a live voice and text service is more or less essential. If the big boys are doing it, why can't you do it? Now we have so FinancialJuice here, as you can see here, we've got the text headlines that have come out here. We have the economic releases on the economic calendar on the left hand side, so you can know what to expect throughout the day, what the markets, maybe what to look out for, what's going to be, what you think could have the biggest market reaction. Of course, non-farm just smashed it today. Then you also have the need to know market risk as well, that is constantly updated as to tell you what to look out for, what's happened in the session so far, and maybe what to expect. What is a risk to your trading day? Of course, this is, as I said, it's if you are a day trader, this is your home, right? To understand what's going in the here and now. You have your live voice feature there as well. And TICKSTRIKE is, see, when I changed this headset, I forgot to turn off the sound settings for TICKSTRIKE, so my ears, I go, that's all I can hear. in my ears from TICKSTRIKE. But I mean, hey, if you've got TICKSTRIKE and you enjoy it, then who here has TICKSTRIKE? Who here has Axe? Who here uses TICKSTRIKE? TICKSTRIKE. But if you do, if you think it's great, then give us some of your feedback on it as well. Super Bartek says I do. Nice. Saying it's amazing. Great. I'm glad you enjoy it. It's good. Glad you find it very useful. So this is the link to the FinancialJuice website. Now, first, so if you want to make an account with us, okay, you can make a free account with the live version. First of all, if you want to go to the pro version, though, it's totally up to you. Whatever you want to do. All you got to do is create an account first on FinancialJuice. Okay, then go to email and verify your account. And then once you've verified your account, then go back to the FinancialJuice website. Then there'll be a button here which says Go Pro. Okay, as I said, totally up to you. Whatever you want to do, you can stick with the live version. The live version does have adverts. There is a little bit of a delay, but it doesn't mean it's not. It doesn't mean it's not useful to have. To have a little play around with and get used to how a live voice and text service works if you've never come across it. Then once if you feel comfortable with, if you want to go ahead and pay for the pro version, there'll be a button here which says Go Pro. Once you've paid for it, go back to the website, log out, and then log back in. So it kind of verifies your purchase in a way, kind of think of it like that. And then you should have the nice pro version of FinancialJuice in all its glory. As what we see here. And here we go. We're just charting. If you did miss Nonfarm Payrolls, you can know how it. Of course, you can look to the markets yourself, but it's also charted on here as well for you to have a look at. If you wanted to have a look at it there as well. If you're kind of quickly scanning through what's happened in the day. Dollar is still flying and enjoying the buzz. Let's see, 10 minutes post trading, 123 pips. So remember, when I look at the deviations, I always go to the wick of the candle on the first candle, right? I want to capture the entire move of what had happened, okay? And then 10 minutes post trade, I look at where the candle ended, okay? Per 10 minutes from the release. All right. Again, more or less, the market reactions already happened. Now, markets are kind of going the way that they want to go. For example, if the dollar still wants to go up, then the dollar yen still wants to go up. Then by all means, go for it. But you don't, you're not capturing the big old initial move after 10 minutes because it's already happened. You just want to kind of capture, seeing, okay, is it going up or has it reversed its gains within that 10 minutes? And then is that an opportunity for myself? Or, how do I use information? That's totally down to you, whatever you want to do with it. Now, if you want the access to the deviations, it's completely free, okay? You don't have to pay for it. All you've got to do is sign up to the MACROACE mailing list, okay? And in that mailing list, hold on, I've got to turn my sound down. There we go. So in the MACROACE mailing list, not only do you get the deviations for the upcoming economic releases for the week, okay, but you also get the rundown of what's expected in Europe, US, and Asia session as well, with a summary of the weekend news. Now, just to clarify whatever your expectations are for the mailing list, it's a short summary, okay? There's no graphs or charts that are put in there or infographics that are put in there. All it is just a short summary of what to expect for the week ahead, because a lot of the data and the explanation comes through me here doing live streams, right? That's where the honey is, baby. That's where the juice is. So that's how the MACROACE mailing list is done. That's one email sent out every Sunday for the start of the week. Okay, so as said, you can subscribe to the MACROACE mailing list if that's something that you're interested in doing. Bear in mind, just for people to know, if you are already subscribed to the MACROACE mailing list but aren't able to access or find the deviations, there are two big buttons, right? That say deviations and the live streams. If that doesn't work, if you're maybe having trouble opening up the live streams or the deviations spreadsheet, then just send me an email. Tony FinancialJuice, I've put it in the chat as well. I'll fix it for you and I'll get you. I'll try and see what the issue is. So that's FinancialJuice. That is also MACROACE for the mailing list. Now TICKSTRIKE, beautiful, beautiful TICKSTRIKE. So TICKSTRIKE, as you can see here, if you don't know what TICKSTRIKE is, TICKSTRIKE basically allows you to listen to order flow within the market. Okay, or a simpler way to put it, it allows you to gauge the strength of the buying or selling momentum within different asset classes. Okay, within the markets. Now here is what we call this little box here is called the ticker. Okay, representing, here we go, we've got cable. Bring out cable here. Now whenever there's a bit of so what are these numbers showing here, and what is this slide all about? Explain to everyone. So the minus figure shows, of course, the selling momentum. You can see here, so a bit of selling going on cable, and the plus sign, the buy momentum. Now, on this here, why are there different numbers? Okay, so 1 is the most sensitive to market reactions. So when there's, as you can see here, there's a little bit of selling that's kind of going on, TICKSTRIKE will kind of give you an alert to it. Okay, visually and audibly too. But you can kind of chop and change the level of sensitivity. Okay, so if you want, so you can go all the way to level 15, which is the least sensitive to market reactions. So when there's a big movement that happens within, or if there's a big amount of volatility that's happening, or buying or selling momentum, then normally that normally happens for the asset, then TICKSTRIKE will only go off for you then. Right, but remember, you can kind of chop and change that and do whatever you want with it, or find out what level suits your trading style. Now there are many different asset classes. You've got your FX, you've got your stocks, you've got your futures as well to look at. You've also got your ETFs and ETNs, and your internals as well. So like your VIX, if you want to have a look at that, see how that's doing. So here we go. Wow, this is nice and juicy. This is probably, this is a very, very strong, compared to the last Nonfarm Payrolls report, where it was kind of a doozy. It did do a lot in the market, but like the strength of this looks stronger. If I actually, you know what, let me just double check. Let's see, so 460 ticks down, 10 minutes trading. 374 ticks. Okay. So the last time round, if I just bring it up here for you, you can see what the difference is, right, between the releases, between the last couple of releases. So here you had 744 ticks towards the upside on the NQ, but the pullback was then after 10 minutes of trading, it was up by about 348 ticks post the release. Okay, there's a bigger pullback that happened on the NQ the last time around. Here, although yes, it's not as big as didn't see a big initial reaction, the pullback isn't that big compared to what we'd seen last time around. The difference is about 100 ticks or so compared to 700, or compared to around a 400 tick move or difference between 10 minutes and between the 1 minute candle and looking at it 10 minutes afterwards on the chart. So that is the economic release. We also, other than TICKSTRIKE and MACROACE and FinancialJuice, we also have unusual activity. So if you like trading unusual volume activity in stocks, forex, crypto, also bear in mind TICKSTRIKE also has crypto as well. So go back to unusual activity. If you like trading unusual volume activity in stocks, FX, crypto, futures, okay, then you can join our free beta test group of the new service that we've launched, and you can have a little play with that as well. see what. Give us your feedback. As I said, it's completely free. We're beta testing. We need people to kind of criticize it. Give us your ideas and thoughts. What could be added? What could be changed? What doesn't work? What does work? All that sort of feedback is very useful, because that's how, first of all, FinancialJuice was built, and MACROACE as well. So that's what we want to do: is take your ideas and improve upon and change things where they need to be changed. Okay. Let's have a little look. Let's have a look at some of the other ones. Yeah, let's have a look at the 10-year. See if we actually, let's see if we had a bigger movement on the 10-year compared to the 2-year. About 44 ticks. So the 2-year bond, being the shorter term, shortest end of the long-term rates, had the biggest reaction. But I would be foolish not to look at the 30-year either as well. Okay, 36 ticks. Yeah, so your 2-year has done quite. 2-year bond prices are doing quite well. All right. That is it from me, from Tony MACROACE. Thank you very much for joining me. I hope you found the information useful and informative and helped your trading. Yeah, we were looking for a 60k deviation at least. Well, we definitely got at least a 60k deviation on Nonfarm Payrolls on the headline figure. So yeah. Anything with stand issues, yeah, we're gonna work on it. I thought I'd kind of give it a go, see what happens. So I move my head around a lot, and sometimes we have, if the mic is trying to pick me up, then that's something that I was just trying to it's just like a quick fix. Just kind of give it a go, see what happens. But don't forget, share the video, like the video as well, subscribe to the channel, get the word out there if you found the information useful, and I will see you next time. Uko Mako says great show as always. William Riker says thanks Tony, great job. Alright, sayonara guys, take care, have a great weekend, and I'll see you guys next time.